When the president landed in Beijing this week, it was pitched as a massive diplomatic rescue mission, a high-profile attempt to repair a broken global supply chain. The optimism caught fire fast. Wall Street spotted NVIDIA CEO Jensen Huang in the U.S. delegation and immediately priced in a victory. Traders assumed this meant an AI chip trade deal was imminent, sparking a massive three-day rally in tech stocks. But while the cameras were flashing in China, the reality back home was entirely different. The U.S. stock market was quietly bleeding out in one of its worst single-day drops of the year. So how does a diplomatic summit that produced exactly zero actual policy changes manage to instantly drive up the cost of your groceries and your mortgage? To understand that, we have to look at what broke while everyone was watching the politicians. This chart shows the yield on the 30-year U.S. Treasury bond. For years, this line was essentially asleep. But this week, the cost for the U.S. government to borrow money on a 30-year timeline spiked past 5% for the first time since 2007. That same day, the collateral damage hit the commodity markets. Crude oil blew past $105 a barrel, pushing retail gas prices up a staggering 51% from where they sat just a few months ago. This matters because government bond yields act as the bedrock for all other money in the economy. When the government has to pay more to borrow, every single other financial decision, from corporate debt to your personal credit card, automatically gets more expensive. This was a historic stress test on the basic cost of money itself, and the pressure came from a very specific geographic location. This map shows the Strait of Hormuz, a 21-mile choke point that normally handles 20% of the world's daily energy supply. Thanks to the ongoing war with Iran, that massive flow has been completely blocked for over 2 months. The entire market rally earlier in the week was built on a very specific assumption. Because China is the primary buyer of Iranian oil, they hold unique leverage over Tehran. Investors assumed the U.S. was going to ask China to use that leverage to force the strait open. That assumption collapsed on Friday. The president explicitly told reporters he did not ask China to intervene, stating flatly that he refuses to ask for favors. Then came the secondary blow. The U.S. trade representative casually confirmed on national television that semiconductor export controls, the exact thing driving the massive tech rally, were never even discussed. The sell-off that followed happened because the market finally understood the reality of the situation. There is a complete geopolitical vacuum, and no one is coming to save the global supply chain. This panic was a planetary repricing of risk. Government bonds sold off simultaneously across the globe. In the UK, severe political turmoil and the threat of heavy deficit spending pushed their 30-year government borrowing costs to levels we haven't seen since 1998. Over in Japan, a nation that produces essentially zero domestic oil, the sheer shock of importing energy at $105 a barrel drove their 10-year yields to 1999 levels. And in Germany, borrowing costs reverted to the heights of the 2011 European debt crisis. Europe is trying to absorb a severe Middle Eastern supply shock, and this time they don't have cheap Russian gas to act as a safety net. A single, motionless military choke point halfway across the world has forced the entire planet to recalculate the cost of surviving the year. All of these abstract global numbers you see on Wall Street eventually land directly on the American consumer. This chart shows how the mechanics are immediate. When that Treasury yield crosses 5%, 30-year fixed mortgage rates automatically adjust upward, entirely freezing out first-time homebuyers. Auto loans and credit card annual percentage rates follow right behind it. Then there's the 6% jump in wholesale inflation recorded last month. That cost doesn't disappear. It gets passed along to retail grocery shelves in exactly 60 to 90 days. You can already see this geopolitical tax kicking a bite out of household incomes at the gas pump, where prices have become a severe daily drain on commuters. This is the quiet, forced restructuring of a monthly household budget by macroeconomic forces completely out of the consumer's control. The institutions built to manage this are paralyzed. The Federal Reserve cannot execute their planned interest rate cuts because inflation and oil are moving in the exact wrong direction. Promises of future private sector deals, like potential Boeing aircraft orders, offer no relief for an immediate, systemic inflation crisis. The entire global financial system, from Wall Street to your wallet, remains hostage to a motionless 21-mile strip of water.